Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about pensions. Some neat stuff. What they are, why they're important, what kinds of pensions there are, how we do the simple journal entries for a defined contribution plan versus the more involved calculations in a defined benefit plan. And we've gotten to do tables and journal entries and T accounts, all sorts of fun stuff. You know, it always surprises me as I talk about pensions with my classes. I've always got somebody that stops me around now and says, boy, this is really complicated. I don't like it. No, you should love it. This is great. This is job security. People wouldn't hire us to do easy stuff. They hire us for the fun, challenging stuff that gets people thinking and that they don't want to handle. So enjoy pensions and these other challenging topics for what they'll do for your bottom line. With that, hopefully as a pick-me-up here halfway through our discussion, or perhaps a little bit further on, let's wrap things up. And the first part of that is to go back through our steps again and see how they all come together. So if you remember, we start out our calculation of pension expense by first figuring out our beginning balances. So all of the ending balances for last year, we're going to gather those numbers and put them into our worksheet as our beginning balances for this year. Next, we're going to do what we call the normal adjustments. These happen every single year, and they directly affect pension expense. The service cost adjustments for the way our employees have worked for us, the interest costs that take care of our present value estimates, the expected returns that smooth out what we think our plan assets are going to make for us. We then make adjustments for some non-expense items. That's step 3. These happen most of the time, but not necessarily always. As a company, we may make contributions to the plan. If we've got retirees, the plan is paying out. If we have actual returns where we've made some real money, not just the estimates, but real returns, we take that into account. And then if the actuary has changed the statistics, then we make that adjustment as well. In step 4, we do our amortization for a prior service cost. And again, if there is a prior service cost, we are going to amortize it. If we have accumulated OCI, actuarial gains and losses for our pensions, then we are going to do a test and make sure they've not gotten too big because we're not estimating well. If it has gotten too big, we do an amortization. If it's not, then we don't do that amortization. So these amortizations only happen if they're needed. Finally, to wrap all of this up and bring it back together, yes, the best part, we get to do our journal entry. Now, I want to take some time right now and start doing a full comprehensive example that pulls all of this together. But before we do that, we need to take just a minute and talk about IFRS for pensions. Now, there really aren't a lot of significant differences between the two sets of GAAP. But you should know, when we have a prior service cost, we renegotiate that contract under US GAAP. We immediately put that into our projected benefit obligation, and we record an accumulated comprehensive income prior service costs. We don't have to show it as an expense or a gain right now, depending on how the negotiations go, but we do put it into accumulated OCI. And then we amortize it away. We get rid of that balance as our employees work until retirement. Under IFRS, you do amortize it, but you don't amortize it out like we do under US GAAP. You amortize it in. So instead of putting it into the system, having it in the system up front and then slowly reducing it away, you add it to the system as you go. So a slight difference there in the way that we do things. Also, if you're outside the corridor under US GAAP, remember we do that calculation and figure out how much we have to amortize away based on how far we are outside the corridor, and we slowly would smooth it in over time. Under IFRS, you can do it that way if you want, or you can just do one big write down. So if we were to look at our example again, under US GAAP, we recorded just $6,000 of this $35,000 that was too much. And then next year we'd check again, and if we needed to, we'd write it down a little more and a little more and a little more. Under IFRS, you can do that, or you could just say, you know what, I'm $35,000 over, I'll write it down to 35. So that's an option allowed under IFRS. That's not really an option under US GAAP. In addition to the current standards, there are just a couple of things IFRS is thinking about that may cause some differences in the future. And they're still just up in the air, but just so you're aware that IASB is thinking about this. Number one, they want to get rid of corridor smoothing completely. So you won't have any smoothing. You'll have to write it down by the full 35 when you realize there's a problem. Second, they want to separate out on the statement of position the different parts of pension costs. Now, a statement of position is what IFRS calls its income statement. So they're thinking about breaking things down. So the interest cost is separate from the amortization, is separate from the expected returns. And we get it all broken down that way. The last thing they're thinking about is creating a new category. So instead of just defined benefit and defined contribution, you'll have what they are calling a contribution-based promises category. And this is a pension that they don't guarantee what you'll have as you retire, but they guarantee a balance. So instead of saying you'll have $500 a month for the rest of your life, we guarantee you'll have $1 million in your savings by the time you're done. And then what you do with it after that, that's up to you. So they're thinking about making a middle category to capture this group of pensions that are already being used by companies. And that's about it as far as US GAAP and IFRS. Really just a couple of very small differences currently in the mix, a couple of others that may come down the pike, but we'll see if that really happens. We've reviewed the steps. We've talked about IFRS. We've done some basic examples. It's time to pull it all together. Let's get started on a comprehensive example that brings this all together. Because of time constraints, we're going to continue on with the ROS 1 company that we've already looked at, which means we're going to keep using the prior service cost amortization table that we already looked at in example number 2. So please make sure that you have those numbers ready because we're going to keep using them moving forward. If you remember from our example number 3, we started out at the beginning of year 3 with a PBO of $1 million, although I'm going to write it in thousands just to save some time. Plan assets were $800,000. Again, we're going to write it as 800. We had a debit balance and accumulated OCI actuarial gains and losses of $135,000. And here's the rest of our information about year 3. So there's 110 in service cost. There's our discount rate that we'll use to get our interest effect and unwinded the discount. We've got 10% as our expected rate of return. Our actuary has changed some assumptions. Our PBO is growing. That's what that means, is a positive number. If a PBO grows, that's a credit, so we'll have to put that in as a credit. And then there's that $200,000 revision because of the changing contract that was part of example 2. In addition, ROS 1 has told us that they have contributed $120. The trustee that is investing the plan assets says that they made an actual return of $90 and they paid out benefits of $105,000. So with all that information, we are ready to jump into our worksheet. So I'm going to start right where we left off last time. You can see all of these numbers match what we did before. There's the beginning balances. There's the $200,000 that we added in, and there's our $36,000 amortized away of prior service cost and the $6,000 that we amortized away because of corridor smoothing. This is step 1. Let's move on to step 2. And the first thing we need is our service cost. It's a cost, $110,000. So I'm going to debit pension expense, credit my obligation. Next is my interest cost. And we were told that our discount rate for this year is 9%. And we need to multiply that by the PBO. Now, really important point here. We need both of these numbers when we calculate the interest cost, because when our actuary came up with the value of the prior service cost adjustment, he or she would have adjusted for time value of money. So starting immediately, I've got to start unwinding that discount. So instead of using just the 1,000, I'm going to use the 1,200. And that's going to give me 108,000, increases the expense and increases my obligation. For the plan assets, we were told we had an estimated return of 10%. My beginning balance in plan assets is 800,000. So I'm going to reduce my pension expense by 80. I'm going to take that 80,000 out of that actuarial gain and loss, supposedly pulling from the actual returns that I've been keeping track of in there to reduce my pension expense. But of course, we know because of the corridor smoothing that this company hasn't done the best job at making those calculations. Next, step 3, we jump down here. They did contribute to the plan this year, so cash went into the plan of 120. So plan assets go up by 120, debit and credit. The retirement benefits paid, again, were given to us, so 105 went out of plan assets and reduced my obligation, again, debit and credit. The actual return was 90,000. So plan assets went up by 90. And I put that in my actuarial gain and loss. And you can see right here, not too bad. And we're off by 10,000, but judging by the larger numbers we've seen before, that's actually probably pretty good for this company. So we're doing okay. The last thing was we were told that there was an actuarial adjustment to our PBO. And you have to be really careful with these numbers. I'm just going to tell you that my assumption in writing these down was that a positive number meant that it increased the PBO, so it's a credit to PBO, and a negative number would reduce the PBO. That's how I've written them in this example. But you'd want to get into the fine print from your actuary and really make sure, wait a minute, is this increasing or decreasing the obligation? You'd have to make sure you knew which way the actuary meant before you did the calculation. So if I'm going to increase the obligation for 33,000, that's a credit. And that's going to go in my actuarial gains and losses. We mentioned the fact that companies will have separate accounts. Some of them will. This is one of the reasons why they might break it out into a separate account, is for adjustments like this. Next step is to do my amortization. It happens sometimes. They affect the pension expense every time. We've done these calculations already, but let's just look at them briefly. Again, here's our 135 that was above the corridor. Remember, and I'll just draw it quick. We had 100 and negative 100, and we were up here at 135. So we needed an adjustment of 6,000. And then here's our summary of that whole huge calculation we did. And there's that 36,000 when we round it to the 1,000. In this case, I've already accounted for them. But if I hadn't, I would need to do all of those big calculations right now so that I knew the numbers and was ready to go. The last step now is to do our journal entry. Yes. And to do that, I need to add numbers up. So if you remember, we're going to add all the numbers from here to here to give us our journal entry amounts. So 110 plus 108 minus 80 plus 36 plus 6 gives us a value of 180 for my pension expense for the year. Negative 36 plus 0, because there's nothing else, gives us just that negative 36, or a credit of 36. And now I can take 200 plus that credit of 36, and I end up with a balance of 164, which is what we want to see. We want to see it getting smaller. Let's see, 80 minus 6 minus 90 plus 33 gives me a value for my journal entry of 17 and an ending balance of 152. Let's see, for cash, we've got a credit of 120. I can't do an ending balance in cash because there's too many other things going on in cash. And I can't do a pension expense ending balance because it doesn't have an ending balance. It gets close to retained earnings. And then I leave this blank. So now let's see. Now we add up these big columns. So negative 1,000, negative 200, negative 110, negative 108, plus 105, minus 33 gets me an ending balance, a credit of 1346. 800 plus 102 minus 105 plus 90. I've got 905 saved up in plan assets. I get the difference, and that gives me this number. And we end up with a credit of 441. So a really big adjustment there. Well, now that I've got all of these numbers in my worksheet, I get to do the best part, and that is the journal entry. Again, we've got the 180 down here. That's our total pension cost, not our total pension expense anymore because of the change that FASB just made. So we're going to break that 180 down. The 110 up here is going to go into compensation expense. And the rest of that value, the 180 minus the 110, that will go into our net pension cost. It's still a debit, so it'll be a cost and not a benefit. Let's go ahead and get those in there, and then we'll add the rest of the entry. Compensation expense, 110. Net pension cost, 70. And the sum of those two gives us that 180. That's got to be our total pension cost. Then we have our accumulated OCI, actuarial gains and losses. It was a debit as well for 17,000. We had a credit to cash of 120. and a credit to accumulated OCI prior service costs of 36. And if I calculate the difference, 110 plus 70 plus 17 minus 120 minus 36, I find that I need a credit to net pension obligation of 41. This is an adjusting entry for pensions. Now I don't stop there. Remember, I'm not done till I've checked and made sure that my T account comes out the right way. So I'm going to abbreviate this, net pension obligation. And we started the year with a negative or credit of 200. And I've just added a credit of 41. So I show a balance right now of 241 in my net pension obligation account. If we go back and check, we'll see, shoot, that doesn't balance. What have I done wrong? I made sure everything came from that journal entry and the 180 was right. I mean, I split it into the 110 and the 70, but it should still be the right number. 36, $200 off. Oh, wait a minute. I never did an entry for this $200 change when I renegotiated my contract with my employees. And that changed my other comprehensive income for prior service costs. And because I don't have a PBO account, it will also change my net pension obligation, because that's where I keep track of the PBO and the plan assets. So let's go ahead and do that journal entry. We had accumulated OCI prior service cost debit of 200, and then we have our net pension obligation, since that's where we keep track of the pension obligation and the plan assets. And this will be to adjust for changes in plan obligations due to renegotiation with employees, or something along those lines. And now I can bring this 200 up here. I get a new balance of 441 credit. I have to bring that down. That's going to bug me. There we go. Now it looks beautiful. And there's my 441. Please make a note to yourself, circle it, highlight it. If I have a prior service cost change, then I need a journal entry for that change. Otherwise, things aren't going to balance because I put it into my worksheet and not put it into my actual account. So you've got to have both there. That works us through the first part of our comprehensive example. When we come back, we're going to continue walking through an example so that you're comfortable with this process. Lots of fun coming up. I'll see you then.